then the entire firm must be worth $250,000 after Carl invests his $50,000. Simple arithmetic. The bag of goodies that represents the firm must have more than just those lawnmowers and trucks that were worth about $100,000 a year ago. What might we be missing? You've probably guessed it. Multimower has something that we can't kick. It has intangible assets. After 5 years, Multimower has a nice roster of steady customers. Steady customers are worth more than infrequent, spotty customers. Let's make it concrete. How much is one good lawnmower worth? For the sake of argument, let's say we agree it's worth $3,000. Now let's add those steady customers. How much is this lawnmower and a list of people who will pay you good money to mow their lawns worth? My guess is that the mower and the steady customers are worth quite a bit more than $3,000. That's part of the reason Multimower is worth more than just the tangible assets in the goodie bag. Multimower has another important intangible asset. After 5 years, Multimower has earned a reputation for good service at a fair price. When people move to the area and ask their neighbors who mows their lawns, they say, Multimower. Multimower is getting the best advertising in the world for free. Let's change the story just a bit. Let's say that Multimower doesn't want to raise extra funds and won't be issuing new shares anytime soon. But co-investor Carl still wants to get into the lawn care business. Can you make this work? The answer is yes. Instead of Multimower issuing new shares, you can sell Carl some of the shares you already own. In this case, Multimower doesn't receive any new funds at all. Instead, Carl gives you $50,000 and you give Carl a quarter of the company. Yes, I said a quarter of the company, not 20% of the company. Why a quarter? The reason is that Carl's money is going to you personally in this case, and you are giving Carl some of your existing shares. Multimower isn't issuing new shares and doesn't have access to the money you got from Carl. Multimower isn't getting a cash infusion, and it isn't any bigger than it was before you sold your old shares to Carl. You don't have to sell part of the company to raise some cash from it. You own the assets of Multimower, and you can choose to write yourself a check if you like. If Multimower has $1,000 more in cash than it needs for day-to-day operations, and if it doesn't have any major purchases on the horizon, then it probably makes sense for you to use that $1,000 somewhere else. A payment from the company to the shareholders is called a dividend. If you had sold a quarter of Multimower to Carl, 250 shares, so that there's 1,000 shares of Multimower in total, then we'd say that Multimower had paid a dividend of $1 per share. Carl would get $250 and you would get $750. Not all companies pay dividends. Usually it's for one of two reasons. First, some companies don't earn enough to cover their cash needs. This is most common for companies that are growing rapidly. They need all of their cash to buy the things that they need to expand, so there's none left over for dividends. Fred Smith founded Federal Express Corporation in Little Rock, Arkansas in 1971. FedEx did rather well over the years, but didn't pay its first dividend until 2002. If you're adding expensive new air freight jets every year, then you aren't going to have any cash left for dividends. Another reason that companies don't pay dividends is that they've fallen on hard times. For example, Delta Airlines stopped paying a dividend in 2003 and didn't reinstitute it until 2013. In fact, most major airlines weren't paying dividends at the time. Professor Severin Borenstein of the University of California, Berkeley, says that domestic passenger airlines lost $10 billion from 1979 to 1989. In the 1990s, they made about $5 billion in profit, and then they lost $54 billion from 2000 to 2009. Airlines just